Iliad Partners is a new venture capital firm based in Dubai, focusing on early stage startups, investing in the Middle East region. And I'm here today to talk to you about how to give a good investment pitch to an investor, something hopefully that will be useful to you. Actually, before I get started, I did want to get to know you a little bit better. So if you don't mind, just very quickly go around and give me your name and the name of the idea or the company you're currently working on, and then I'll tell you a little bit about myself so we get to know each other from the beginning.
I'll start. Okay. Hi everyone. I'm Haris. I'm actually founder of Medi. It's a platform to help you find best doctors in Qatar and GCC. Think of us like Yelp for doctors.
Okay, great. Nice to meet you.
Thomas, I've recently joined the Launchpad program, 6-month program, still in design development stage. Working on a platform, think of Instagram meets Amazon, those two combined.
Very interesting. Nice to meet you.
Company Qatar Hire. We are online hiring solution. We connect job seeker, manpower agency, and employer.
Great. Nice to meet you.
Hi, my name is Wasim. I'm the founder of Iliad Partners. Is an e-commerce online shop. And you have qatarbasis.com online.
Great. Nice to meet you.
I'm here working for Urban Point, which is a company that is going to be launching an app to build on lifestyle based on offers in Doha.
Great. Sorry, what was your name again?
Amir.
Amir, nice to meet you.
Nice to meet you.
I'm Walid. I'm co-founder for mobile application virtual e-books. This mobile application is to change the physical e-books to a virtual e-books you monitor and control in your hand.
Great. Nice to meet you.
Hi, my name is Rashid. I'm the founder of Red Block Social, and what we do is social networks for the service.
Great. Sorry, I didn't hear you. Great. Nice to meet you.
Yeah, I'm Ayman. I'm co-founder of Iliad Trading, Qatar Best Deals, which is an online e-commerce platform for mainly electronics.
Great. Nice to meet you.
Ajit Kumar, and the co-founder of Iris Car, which is a cloud management company. We provide technology travel solution to the corporations.
Great.
Hi, Mufid. I'm from Evently. Evently is a mobile app for curated events in Doha.
Great. I've heard of that before. Is there a...
Another name too. I mean,
Great. Anyway, it sounds familiar, so
yeah.
Nice to meet you.
Even.ly, that is.
Yes. Okay. And your name?
Azhar.
Nice to meet you.
Susanna, one of the co-founders of Urban Point.
Okay, great. Did I miss someone? Two people.
I'm Iliad from Ozone Studio, a digital marketing company.
Great. Nice to meet you. And?
Hi, I'm Qasim from Makers Company. We're working on Diet.com, which is a diet-related platform.
Great.
By consultancies.
Excellent. Nice to meet you. Sorry to do that, but it was great to get to understand a little bit what everyone's working on, people's names, etc. Tell you a little bit about myself. I've recently launched Iliad Partners. Iliad Partners, as I said, is an early stage VC based out of Dubai, focusing on early stage companies, primarily late seed and Series A, purely focused on tech. And within tech, there's a lot of areas which we find interesting. Focused on the Middle East, based in Dubai, as I mentioned, and working with a number of partners based out of Dubai and actually Qatar. I've been coming here quite a bit, working with ICT Qatar now as a mentor of the incubation center. So I'm happy to be here. Just to give you a little bit more about my background, before Iliad Partners, I was head of business development and partnerships for Yahoo Maktub, the internet portal, which you may know. My role there, I was there for about 3 years. My role there was how to grow the company in the Middle East through partnerships, whether that's on the media side, internet, e-commerce, and other sort of core partnerships. And before that, I was a consultant with Booz & Company, a consulting firm. I was there for about 4 years. And I've been in the Middle East now for 8. originally from Greece. I did my MBA at MIT. So that's a very brief overview of what I've done. I'm not going to take you through this very detailed slide of what I've done, but one of the key things also to let you know is I've been involved in 7 different startups. So hopefully that can bring in some perspective there. And also I've been a judge and a mentor for a number of different organizations like MIT Enterprise Forum, Endeavor, ArabNet, and what have you. So the purpose of today's chat or discussion is I'm going to take you through a quick presentation of what makes a good investor pitch, some of the basic themes and ideas. Please feel free to interrupt me at any point with any questions you may have, and then we can use this as a catalyst for any questions you may have. So the topic of discussion is mainly, how does one make a good investor pitch if you're going to raise money from investors? But from there on, I'm more than happy to answer any other questions you may have when it comes to fundraising, venture capital investors, who's the right investor to approach, who's not, what are the do's and don'ts of the process. So some of the key things that we're going to go through in terms of the presentation. One is, an overview of preparing the pitch deck, a pitch deck to investors. Some advice on delivering a good pitch. Managing investor questions. It's also a very important part of the equation. Common mistakes to avoid. It's a useful thing to discuss. And then, of course, the main part which I want to focus on is the discussion and Q&A that you may have based on our discussion. So first part, as I said, we're looking at preparing the pitch deck. So the purpose of your presentation is to provide a brief yet compelling overview of your concept, right? It's not meant to give every single detail possible about the company, but it's supposed to be able to entice the investor and get their interest so that they ask for more information. So it's not meant to answer all the possible questions. The objective is to get them interested, open their minds to your vision, and to get them excited to know more about your offering or product and yourself and the team. I should give enough information to grab their interest, but not too much detail. Investors tend to have a little bit of a short attention span, so it's always good to keep their interest and keep things very focused. And this is all your opportunity to showcase the strength of your product, of your team, and your vision to execute your plan for your company or idea. So what are some of the key components of a pitch deck? There's many versions of this, but I think this is sort of what I see as my version or what I tend to see as quite common. There's 11 key components, and then there's a 12th that's sort of optional. So first is the elevator pitch. So it's a very short and memorable summary of your idea. So before you jump into any details, it's good to give this elevator pitch, first slide or even verbally, to tell people and the investors what is this all about. Second is the market opportunity. So, what is the market you're looking at? What is the opportunity in that market? What is the size of the market, whether it's global, regional, or Qatar itself? The growth and some of the target customers. The third, and also very important to sort of touch upon that in the very beginning of the pitch deck, is the problem and current solution. So what is the problem that exists and the problem you're trying to solve with your idea or company? And that is a good step where you are able to create context for the person you're talking to, the investor, to understand the context and tangibility of what you're working on. Fourth is the product. So, what is your solution and what's the value proposition of your idea? What's the business model? This is something you can't forget. Great product, great team, but how do you generate revenues? How is this company going to make money going forward? Sixth is strategy and go-to-market approach. So basically, how will you reach your customer and how will you help them? So marketing and sales and distribution strategy. Another key thing is showcase any sort of momentum, traction, or expertise you have. So what have you achieved so far? What are the main milestones that you have achieved so far? It's always good to show that you've made some progress. whether it's customer validation or your first customers, or you've won a prize at a competition. It's always good to show that there's some initial traction. Team and key stakeholders. So founders, who are the founders? Who's the team? If you have advisors, investors, or board. Actually, many investors like to start that as the first thing, because when it comes to high-tech investing, the number one thing people, and myself included, look at is who's the team. Is it a team that is passionate about what they're doing? Do they know what they're doing? Do they have the expertise? Are they committed? Do they have the right attitude? So this is something always very good to sort of touch upon very early in the presentation. And then comes the more technical, and this is where you turn up your sleeves to do some work in terms of providing financials. What do your revenues look like? What's your cost structure? What's the investment required to get this off the ground? And what's the approximate return that you can give it to investors? Next is competition. So who's your competition? Is there competition? Who's your competition? Is it local? Is it global? If there are competitors, are you concerned about it? How are you going to tackle it? How do you differentiate yourself? How can you create a competitive advantage to protect yourself from the competition? And then, the last or second to last is sort of the punchline. If you're pitching to an investor, you're looking for money. So, how much are you looking for? What are you going to use the money for? Some of the key terms that you're willing to offer to investors if you're looking to raise from them. And then some optional things. I think the basic ones are these 11, but some optional things would include, what would be your exit strategy? What are some of the partnerships you have or want to do? This is also a key talking point. So there's different ways to reach your customer. You can reach them directly, or you can do it through partnerships. So while I was at Yahoo, for example, we signed over 20 partnerships. Some of them were with big companies, so big media companies like CNBC or NBC Group or otherwise. But then we cherry-picked 5 or 6 of the top startups in the region because we really believed in what they were doing. They were plugging in a gap in the market, and the mentality there was, we can't do everything, so we have the traffic. At the time, Yahoo Maktub had over 55 million unique users per month. So you plug in a great idea to the portal, you tend to have a success story. And some of the companies you may know some of them that we've had partnered with include U-Turn, Souk Al-Mal, Istikana, and a few others. And these actually turned out to be quite successful, not necessarily because they partnered with Yahoo, but that was a factor actually to getting to market. So yeah, this is sort of the list of what a pitch deck looks like and should have. There's no right or wrong answers. This is what I look for, or investors I know look for. So I'm not sure how much, if you've prepared a deck for investors before, or if this looks familiar or not. Again, feel free to answer any questions you may have. So in terms of preparing the pitch deck, some tips around style or other things. Brief and concise is good to have, to be very focused. Always try to tell a story, right? So it shouldn't be sort of like an encyclopedia approach to your idea. It tells a story. I personally always like to hear how people came up with their ideas. How did the team come together? It really brings to life the idea and the company and why people are passionate about what they're doing. So there's always a story behind it. And in terms of more technical things, your presentation should be more visual than not. So heavy text can be a bit cumbersome. You should have numbers, so it's good to have numbers there. Accuracy, of course. Mistakes in investor presentations tend to be not a good thing. And I personally would not have more than 10, 15 slides in such a presentation. You always have the opportunity to then meet with the investor, spend time with them, ask them questions, they ask you questions, and then deeper dive. But a good pitch deck, in my view, is between 10 and 15 slides. So then, you've done the pitch deck. Now you're meeting the investor to present it to them. What are some good advice there? So I'm breaking my own rule. There's a lot of text here, so that makes us all a bit dizzy. But A few key things. So number one, actually be prepared. Being prepared is very important to really know your company and your idea, your product inside out. I think this is sort of a very key thing. Be clear, focused, and brief. Focus on key messages. Sometimes I see certain companies or founders, they kind of fall off into tangents. I think in that first interaction with an investor, it's good to focus on the key messages, the story, kind of the key points, because these are the things that kind of stick in their mind. As I said, tell a story. If possible, start with a hook. So some sort of anecdote or story that gets people's, attracts their attention. I think that's a good way to start. Pace yourself. So try not to go too fast or too slow. Adjust it to the audience. I always find useful to try to use analogies. So reference things people know and understand and they can relate to. So using examples is part of the storytelling process. If possible, try to connect an emotional connection with your audience. So first of all, know your audience, understand them, what interests them, what doesn't. This fits in really well with something we were talking with Indika before in terms of sometimes we have the right story and the right idea or the right thing we're pitching, but we're pitching it to the wrong person, right? So to give you an example, if you're looking to raise, let's say, $100,000, and you're going to a growth stage fund, which has a minimum ticket of $5 million, and they're looking for big companies that potentially are global, you may have the best idea in the world, but if it's not in their scope and you're knocking on the wrong door, it kind of, and then of course, I've been an entrepreneur in the past, I've knocked on the wrong doors, and you leave that meeting saying, you know what, you're starting to think like, is there something wrong with my company? Actually, no, maybe I was just knocking on the wrong door. So that's something to think about. In any case, so I think a lot of these things from there on really apply to some, most presentations are sort of in a standard way. So whether it's eye contact, being confident, using a sense of humor, try to stay within the time frame and a strong closing. These are some good tips for delivery. So now you've given your pitch, and now it's the time for the investor to answer your questions. So some ideas on how to do that. Again, being prepared is very important. Trying to scramble to find answers on the spot in documentation, etc. It's not a great thing to be doing. Having data and being specific is always good. So some of the great answers I've seen when it comes to Q&A with investors, whether it's in the initial pitch or later in due diligence, founders or entrepreneurs that can give a very short and concise answer that answers the question with data, and it's so compelling that you don't need to necessarily dig deeper. That's one thing that definitely works. Another key thing is answering the question that's being asked. It can be frustrating in any context. If you're asking question A, you're getting answers to question Z. It can be perceived as dodging the question, right? So you don't want to be doing that. Actually, one thing I really admire is, and I try to do it myself when it's applicable, is if I don't know the answer to a question, I be honest, say I don't know. There's nothing wrong with that as long as you say I can find this out. Of course, if it's a really fundamental question like, what does your company do? Then you're in trouble. But it always pays to be honest. To say, you know what, I will look into this and I'll come back to you. I personally respect that a lot. Another thing is, sorry, go ahead.
Could you just go back on that? Like, what kind of questions have you experienced, like while startups pitching you that they don't know answers to some questions? Like, can you give me like strong examples of like for instance, you asked the startup like, what is the distribution strategy, and they're like, we're not sure with that or something. I mean, can you have any other examples of saying that, like what happened? Like,
right. I'll give you some examples that are maybe indicative. So I mean, if you ask people things that are very basic and they don't know the answer, then I think that's a red flag in itself. So if you ask them, what's your distribution strategy? How do you plan to enter the XYZ market, the Saudi market? Or how much are you raising? Right? So if they can answer a basic question, I think that falls into the bucket of, okay, there's something wrong here. But in terms of what's okay, like if you ask them, okay, what are your revenues from Qatar in year 3? And you're like, okay, well, I don't remember off the bat. Let me get back to you on that. So it's something more specific. It's okay, right? But if it's really fundamental things, it's not a good sign. So I think there's a bit of discretion there, but I think most people we can figure out what's really important and fundamental and you need to know, as opposed to things that you may want to go back and look into. I think from your instinct, you would know what falls into that.
I'm talking about a classic question where investors ask, what is the exit strategy? And when you're starting a company, you're not really thinking of having an exit. I mean, at least not for the next years. So a lot of investors ask, what is the exit strategy? And we're like, we don't know. We might want to get acquired or go IPO, but don't know when that's going to happen.
Yeah, no, that's a great question, and this is a whole category of discussion to be had. So first of all, if we take a few steps back, I personally think that if someone hasn't even formed the company and now they're forming a company, and the sole reason they're doing it is to sell the company one day, I personally believe people do it because they're passionate about what they're doing. They feel they're solving a problem, and there's the whole journey, right? So it could take 5-7 years for a company to be sold if they get sold. So I think also that leads to another question, which is why are people doing what they're doing? If something is at the idea stage and I'm talking to someone and they say, yeah, I want to do this because I want to get rich and I want to sell the company, I'm like, okay, I mean, why else are you doing it, right? So, but to answer your direct question, I would say that's okay. I mean, most companies or ideas, they don't know what their exit strategy will be. You may have a general understanding, right? So like, if you have an e-commerce company, you may want to be bought out by Souk, or you want to get it bought out by Amazon, or maybe by a local big retailer looking to go online. It's okay for people to have a general sense, right? You can't be totally clueless, but I think, especially at the ideation stage, it's way too ambitious to know that, okay, I want to get bought out in year 7 by Amazon at this valuation. I mean, who's going to believe that? Even yourself, right? So I think there's a good balance there. A good balance between people setting up a company or an idea for the right reasons, having a broad sense of where this could lead at some point, but also I think it's a bit questionable if people think that they know what their exit will be before they even launch things, if that makes sense. Any other questions?
One of the very common questions that we face is what have you put, how much amount have you put to your business? Okay, and as most of the startups, sometimes at very early stage, we haven't put any money. We put our time into it. And then sometimes we also get this question, oh, okay, if you guys haven't put any money into it, do you expect others to put money?
Yeah.
Okay.
I get that. I hear that a lot. Look, that can fall in different categories. Okay. If someone is very rich and they're not putting their own money into their own company, that's a red flag. But if you're a startup and you were working at a company, you quit your job, and you're like, okay, will I be able to pay the rent in 6 months? I'm not sure. I don't think it's necessary to put your own money. I think the real question is, how do you measure commitment, right? So how do you measure commitment? If someone is saying, okay, I started this company, I work at IBM, I'm not quitting my job, and I've saved $1 million in the bank, but I'm not going to put any money in that, I'd be like, okay, I mean, so you want me to take the risk for you, right? So that's the thing. But if, on the other hand, if you see someone that, they were working at a company, they saved a little bit of money, but they can't afford to be investing in their own company. But the commitment is that they're full-time. So their career and their well-being, to a certain extent, depends on this. So I think what we're measuring there is commitment. So it depends. It depends. But if people don't have enough money to invest in their own company, I think there's nothing wrong for that, as long as they're committed in a certain way. I don't know if that makes sense, but.
Yeah. So normally, how we answer this question is we say how many hours all of us have put into it.
Uh-huh.
And yeah, exactly the commitment part of it.
It's sweat equity.
Yeah.
Sweat equity in terms of, you are foregoing the income of, working for a big established company, so that you can make this happen, right? It has to be realistic, but I think that the real measurement is commitment, really. So, any other questions? Not for now? Okay, cool. So that was, I think, a good discussion around that. And the last couple of points in terms of handling the questions. Being respectful. What do I mean by that? Sometimes, investors typically have good reason to ask certain questions. If the answer is, don't worry about it, it's not a problem. It's like, okay, it's not a problem, but I would like to know the answer. So I think it's always good to answer the questions. It definitely helps. And always try to close on a positive note. So, well, even if a question is being asked about a challenge or a problem, try to say, oh, we recognize the problem. This is what it is. This is how we're going to solve it. And from this problem, we see this opportunity, if there is an opportunity, right? So I think being, closing on a positive note in terms of answering the question, but also in general, it takes a certain level of an optimist to be an entrepreneur, right? Because if you're a pessimist, it's very tough to say, okay, I'm going to build this company from scratch. And so optimism actually is a good trait to have generally when it comes to setting up, being an entrepreneur. Now, just next thing to discuss is sort of some common mistakes, sort of practical things. In the very first interaction, I think, whether it's too many slides or too much information, you just have to manage the information because only so much will stick. I remember I was a judge for the MIT Enterprise Forum startup competition in Cairo maybe 2 or 3 years ago. I was talking to a very interesting startup. It had 3 minutes to give me the pitch. It was 4 minutes, 5 minutes. I had to leave because I had to go to the next table and look at the next company. And the guy was, coming with me. I'm like, I love what you're saying, but I can't listen to you anymore. So I think being very focused and concise is very important. Wordy slides. So Guy Kawasaki has a pretty interesting rule of 10, 20, 30. 10 slides, 20 minutes, and 30 point font is a good combination. I mean, it could be useful. Too many product details or too many financial details. So it's good to know who you're talking to, if the person is technical or financial or neither, or sort of cater the message to your audience. And the first interaction is typically high level. So you don't want to go into like super detail on technical stuff, especially if the guy doesn't really know technical, or too many financial terms if it's too early in the discussion. I can't emphasize this enough. So wrong data is a turnoff. So you want to be accurate in what you're talking about. Of course, when it comes to building a financial model for your company, it's based on a lot of assumptions. Assumptions are not wrong as long as they're, reasonable. But putting forth data that's not right or misleading is not a good thing. Another thing is belittling competitors, right? So we've always had this temptation, all of us at some point, to say, well, we have these competitors, but they're not good, or they're not. I think it's okay to explain why your company can do better or is doing better than a competitor, but slighting your competition is not a good thing. I think it doesn't show a good personality or character, and generally to be avoided. I was talking about the financial model before. So financial models, when it comes to projecting your finances, typically are almost exclusively based on assumptions. So as long as the assumptions are somehow backed up and they're not false or silly or out of nowhere, you'll be fine. But it's very important to be able to yourself justify where your numbers are coming from. And of course, I think having the right attitude is very key. So that was a very brief overview of how to do a pitch deck, how to manage the discussion with investors, and generally that interaction. Of course, there's a whole earlier part, which is how do you pick the right investor to pitch to, and et cetera. So actually, this part can be a bit more interactive in terms of maybe we can have a discussion on at what stage some of you will be approaching investors, and what profile investors you're looking to talk to, and maybe I can give you some practical advice on that part of the discussion. So how many of you are potentially looking to raise money in the next 6 to 12 months for what you're working on? Cool. And do you guys know approximately how much money you'll be raising? Ballpark?
I have
Yeah.
a question. So when it comes to what's the question?
Okay, no problem.
When it comes to the very early stage valuation, like say it's like a science and a part, like art and a science, like valuing how much your company is in the first round of investments.
Mm-hmm.
So how do you do that? Is there like a thumb rule that
Yeah, I think I have the same question. How do you do pre-money valuation of when you're raising the first ever round? Like, how do you value
So actually, this is one of the most debated concepts when it comes to venture capital and startups. How does one come up with a valuation, whether you're the startup or the investor? And actually, there's no right answer and there's no science. There is a science when it comes to established companies, whether it's doing a discount cash flow or doing multiples of established companies. But when it comes to startups, it's very tough because everything is forward-looking. A lot of it is assumptions. So unfortunately, it is not a science. What you do is basically it's a collection of proxies and data points, which give you an approximate sense. And also and I'll talk about that in a second. And the second part is more of a structural part of what investors and how do investors invest. So in terms of coming up with a prox number, I think the key steps that one goes through is you make assumptions about your sales forecast and your revenues. You forecast that, you forecast your costs, you forecast what you need in terms of investment, and you come up with a basic financial model that says, in the next 5 years, this is how much money I'm going to make, this is how much money I'm going to invest, this is how much my costs are, this is, in year 3 I'll be profitable. So, having that financial model, that's number one. Number two, there is typically a range. So let's say you're a seed stage company. Seed stage or let's say Series A stage companies, typically what they want to do is raise some money, but not give more than 15, 20, 25% of equity. And the reason for that is, foreseeably you will be needing to raise money over several times over the next few years. So if you give away 50% of your company, 40% of your company from the first time, then you'll have trouble having more equity to give away. And at the end of the day, you're the entrepreneur. You're putting in your sweat equity, so you want to have a significant amount of equity. So in case there's an exit, that you actually make an upside. So that's a rule of thumb. Some entrepreneurs say, I'm not going to give away 5 to 10% more than that, or others say, I'll give up to 30 or 40. The industry average is anywhere between 15 and 25% for like a seed, or I would say late seed and Series A. And also typically investors in the VC world, they go for about that much. And now from there on, so that's how much they give away. And then if you're raising, let's say 1 million, you kind of do the math and you come up with a $4 million valuation. Now that's not a very scientific way. So it's a bit of a proxy, and it's also a bit of a rule of thumb and a bit of a negotiation, right? So I've seen extremely attractive startups where you have 3 or 4 investors fighting on who's going to put the money, and they get a higher valuation because they have the negotiation power. And then you have other startups who barely can raise money from one investor, and they get a very low valuation. So it's a bit of a triangulation, including of course how much money you're raising, right? Because number one, you need to know exactly what you're going to do with the money, right? So is it product R&D, product development? Is it marketing? Is it team? Is it all of the above? So one risk is raising too little. Another risk is raising too much. You're trying to raise about right. And so if you take all those data points, which I just told you, and it sounds a bit complicated, but in the end it's a negotiation, you kind of come up with a valuation, how much you're raising, how much equity you're giving. So I don't know if maybe I was able to confuse you more than you were before.
Yeah. So one of the ways is to calculate how much money you need to be on a profit. Let's say like I need like 1 year and like 1 million riyal to be like on a profitable scale,
Mm-hmm.
and then it's up to me or up to the founders to say like how much equity you're ready to give, right?
Yeah. So it's a negotiation. So what you typically in a pitch deck you'll say, this is my company. These are my financials. I'm looking to raise $100,000 for, let's say, 10% of the company. You define that upfront. That doesn't mean that the investors will accept it.
Yeah, okay.
It's a negotiation, but it has to also be reasonable, right?
Okay. And what like the investor and the founders agree are like finally the valuation of the company.
Yeah, they have to agree. So the way it works is if there's one investor, there's a negotiation, then they have to agree. They sign a term sheet. If they sign a term sheet, they then move on to full agreements. If there's more than one investor, typically what happens, let's say there's 3, one of the 3 will take the lead, and the lead investor will determine the valuation, and they agree, and then the other two investors will follow. But at the end of the day, it's a negotiation, supply and demand. And it's an agreement between the entrepreneurs and.
Sorry, so you're saying there is no like a proper due diligence in this stage. It's just negotiation in the seed fund stage.
Not exactly. So there's proper financials and assumptions. The valuation is not proper in the sense that there's no science. Like you can't be like, okay, I'm gonna go get Deloitte or Ernst & Young to do my valuation. They don't do that. It's more of getting mentorship and having someone who knows finance and helping you with that. Due diligence those can be proper. Yes. Because, so let's think about what a due diligence is. It's you look at a company and you evaluate it commercially, financially, technically, product-wise, technical, right? So you can, all these things you can check out. You can call, for example, I can call the startup's customers and say, are you happy with the service? Is the product good, right? You can have a CTO level person look at the code or look at their technical architecture. You can have the legal team review the structure, right? So actually, the due diligence is there. The valuation exercise is just not scientific. It's more of an art. That's the challenge.
Exactly, at this stage.
At this stage.
So
But once you have, a history of revenues, 2-3 years.
2 years minimum.
2 years minimum, then it gets easier. Once the company then becomes profitable, then it becomes even easier and more of a science. So it's a bit of a scale.
The valuation goes up.
Yeah, exactly.
But actually at this stage, like I've seen a lot of startups, and with this stage, the maximum they can get for the minimum equity they can give up is like around $100,000. So I think like now it becomes a science, right? Like okay, if you are in the seed stage, so I'll give you $100,000 maximum for like 20%. Like for example, incubator or accelerators or whoever gives around $30,000 in return of maximum of 15. So I mean like.
I see your point. Yeah, so it becomes a science from one part of the equation. So if you have an incubator, there's lots of them in the region, and they say, we offer you $30,000 for 10% of your company. It's a science from their point of view, but doesn't mean you need to accept it, right? You may say no, but my company is worth much more than this. So the way that doesn't work in the sense that a startup that doesn't agree with their science would not accept this, right? So science is more of like a commonly accepted, right? So I know for a fact that a lot of incubators in across the region, they have a very set plan, and they say, we give you $30,000, we give you free space, we give you this, we give you that, and for this we want 15%. So I don't know if I call that science or more of set terms. I think it's more set terms. Yeah, it doesn't mean you have to accept it though. Maybe you don't think it's the right valuation. So.
As an investor, how do you approach companies that have local partner, non-active local partners with only 51% stake?
So I mean, I think that becomes relevant later on in the due diligence, in the sense that it's not good or bad. It's sort of like the way the company is structured, right? So as long as there's no concerns around the local structure of the company, it doesn't really factor in the beginning. In the beginning, you look at team, you look at the product, you look at the market, you look at competition, and then whether there's certain markets you take into consideration the realities, right? So like in Saudi, or I think also in Qatar, like you need a local partner, and that's part of the reality of doing business. So I don't think it's a good or bad. It's sort of like a reality that we look at. So I don't think it's.
But it doesn't affect the way you evaluate a company, or.
In terms of being evaluated, no. As long as it doesn't get in the way of, how the investment is made or what have you. We come across a lot of companies that have the structure because it's the way things are done in certain markets. So it's not an obstacle, no.
At some point, in companies like that, when you go to a VC or angel round, you kind of reassess the partner's shares, right?
Yeah.
Yeah.
So I think that would, so that would factor in, I think maybe in sort of like either if there's heavy dilution in the first round, or there's a Series B, and then you have to kind of redistribute the partner stake. So if there's like sort of like a minimum threshold where the local partner can only have 51%, and you only are diluting the founder, that's of course can be a bit of an issue. And there's always ways around that, by the way. That's how lawyers make their money. But you you can have an offshore component. There's always ways around it. Yeah.
From your experience, there from any launchpad or idea, like me, I'm in the idea stage now, and soon we will have a prototype. Is it best time for me to approach an investor is to set the company itself, or from the beginning, from the prototype, and I have a tangible thing to approach an investor?
Yeah, good question. So I would say there's no right answer. There's different types of investors for the different stages you're at. So there's the idea, then next stage is prototype, then you have customers, then you're sort of post revenues, and then there's different levels of revenues. So for each of these stages, more or less, there are investors where you can talk to. So at the idea stage, whether it's an incubator or an angel investor, you can speak to them at that stage. Also for the prototype. And then, then some VCs start looking at customer and post-revenue companies, etc. So at any stage of the spectrum you're at, there should be someone you can talk to. Now, from a subjective point of view, and in the startups I've been involved in as an entrepreneur, I personally try to bootstrap it up until the point where I have a product and I can prove to the investor that this product can be sold, right? Because why? Because if you go raise money too quickly, you'll be giving away too much of the company too early, and you're doing all the work, and you have someone who's giving you $10,000, $20,000, $30,000, and they already own a big chunk of the company. So from a scientific point of view, you can approach investors at any point. But in my view, and this is my personal perspective, I would try to bootstrap it as much as possible. So like, in some cases, with some of my co-founders, we had raised money from friends and family, right? So you raise money, these people are not investors, they're part of your family that may be able to give you some money. You set up the product, you have a prototype, then you are able to prove that you can sell it, that there's testimonials from customers that either they want to sell it, or you survey them, or you have clients. And then after that point, I personally would try to raise money.
Is it a good idea if you raise money from family and friends, and after a while your company is like, you pass some stages and stuff, and you go to an investor and you say, okay, listen, so I have some liabilities. It's not going to be much, that's for sure.
Well, one factor is how well do you get along with your relatives, But no, to answer, yeah, I know. No, so actually a lot of people do this. So, their friends and family rounds are, the angel round is done by friends and family. It's common, and as long as everything is documented, it's done properly, you give people, the contracts they need, etc., and you disclose this to the new investors. So actually that's not a liability, it's you give equity, unless you're raising as debt. If you're raising as debt, then you have to disclose it to your investors. That's actually an interesting point, more generally. In your discussions with investors, it's always good to always be honest and disclose things. So you don't want to be like 2 days from signing the contract and say, oh yeah, I forgot we owe $200,000 to this guy in whatever. It's not a good thing.
A very basic question, but I think like all of us have this doubt. So when you say like an investor is investing like $500,000 in your company, does it mean that it's kind of a loan, or does it mean that he's going to make that money back only like from his share of the profit that comes?
Yeah. So this is up for discussion. If you were to oversimplify the universe, there's two types of investments. One is equity-based, and most investors go for equity-based, which means you get X amount of dollars for X amount percentage of the company. So they own a share, they become a shareholder. The second type, and this can be a bit more tricky, is what we call convertible debt or convertible note, which is debt, which means they're loaning you, and then in the second round, you promise them that they will get a share of the company at a certain discount and certain terms. But a few things on debt. So it's up for definition, right? A few things for debt though, like you have to watch out for the local laws. So like if your company goes bust and you owe people money, each country has different laws about how this works, and you have to watch out for that. I don't know, did I answer your question?
Yeah, so it's convertible notes and equity.
Yes.
And when you say convertible notes, and you said like they get back their money only during the next round, is that correct?
They don't get their money back. They get the shares. So it's a convertible. So the money gets converted to equity.
Yes.
Okay.
So
But
yeah.
you decide in the beginning that how much that equity is.
So there's I mean, this we can do a whole session on this, but in a high level, I would say, let's say I loan you $50,000. It's a convertible note. The agreement between us, an example would be that when you raise Series A in a year, you will give me my debt will convert to equity at a 20% discount. So if you're raising at if you're raising $1 million at a $5 million valuation, you'll give me a 20% discount on the investment I make. That's the incentive. So I get a future financial incentive, number one. Number two, sometimes during this time, you pay a dividend or a coupon on the debt. And this way, you get people to, incentivize them to give you debt.
Well, one question.
Sure.
Talk more about your firm. Like you said, you started about a year ago. You're doing late seed and Series A. Can you talk about what kind of companies you have in your portfolio? Do you have a focus on a vertical or sector, or are you sector agnostic?
Sure. So we're still actually in the launch stage. And actually, I'll take a step back to tell you what inspired me to go. Because I was a digital media executive and I was also an entrepreneur, like you guys. But what inspired me is a few things. Number one, seeing sort of the vast opportunity of growth in this part of the world. But also at the same time, seeing a lot of the gaps that exist. So for example, one startup I co-founded and invested some of my own money and was a co-founder, and now I'm on the board of it. It's called Glambox. Glambox is an e-commerce company focused on women in the Middle East. And we raised friends and family money, as we were discussing, and then we put our own money. And then in Series A, that was the seed round. In Series A, we raised money from institutional VCs, and then we raised money from big family groups in Saudi. In any case, in this startup experience and others I had, one thing that inspired me in a, let's say, not a so positive way is that from investors we got money, but we didn't get value add help. And having spent a lot of time in the US and Europe and seeing that things work differently, I was inspired to say, you know what, I've been an entrepreneur, I've been in digital media, I want to be investing in startups, but also try to help them. Because actually, the money is the least of your concern. It's getting that help you need, the advice, people helping you get clients, get into new markets, opening doors when it comes to big partnerships. So the help is much more important than the money, in my view. So that's some of the things that inspired me to get into it. So Iliad Partners, as I said, we're based in Dubai. We're focused on investing in startups in the MENA region. We still have not made the first investment. Now we're working on investing in the first 2 or 3 companies in the next few months. We focus on late seed and Series A. The broad spectrum of money that our ticket size, so-called, is between $500,000 and $2 million, with an average about 1. Specifically focused on tech. And within tech, there's a few spaces. We're not exclusive on any area, but there's a few areas that we like. Internet services, so business models that are sort of based on Airbnb or Uber models, which are low on assets and have network effects and can grow very quickly. One of the key factors that we like to see is scalability. Can this company grow outside of its market throughout the MENA region, Arab-speaking region, and possibly outside of the boundaries of MENA? So other tech areas. So internet services, mobile is a big area, digital media, analytics, e-commerce enablement. So all the ecosystem now that's growing around e-commerce, payments, logistics, maps, or different things that address key obstacles to growth in the e-commerce. So these are some of the areas. Specifically now we're looking at companies in a few areas which sort of fall into some of these. So one we're looking at is in the fintech area, which is a hot area. One is in e-learning. Another one is digital media, digital content. So actually across the board. We look mainly at sort of software and cloud-based services, not hardware or things that are heavy on assets. But doesn't mean we wouldn't look at it if it's very interesting. So that's a very high-level overview of the firm.
Just a question related to your experience. What's the type of investor you want to be? Because I know some of my friends, if I go ask them, I can give you this much, but do I really want to work with them for the long term? I mean, you can get the money, but it's sometimes not clear to me.
Yeah, this is an excellent question.
You want to be there.
So, of course, you want to be in a position where you can choose who you can take money from. I think this is the best situation to be, but people are not always in that situation. So, a few things. So, it's not the case necessarily, but think of money almost as a commodity. And you think of it as a commodity, and you think of it's not how much money you raise or the fact that you raise money, but who you raise it from. So some things that can be helpful, can this person help you grow your company, right? So let's say you are a digital media startup and you have some guy who's very rich and wants to put his money, and another guy who wants to maybe put a little bit less money, but he's a senior executive at NBC Group or Al Jazeera or something that's relevant to your space. So I think my criteria always has been, whether as an entrepreneur or now as an investor, if I can add value or getting money from people who can add value, right? So I think that's my advice. So if it's someone that can help you, give you good advice, help you on the strategy, someone who will be involved if you want them to be involved and can help you. Now, that said, there's smart money, and then there's also other types of money that you'll need. So if you're raising $2 million, you have a few sort of industry people that can give you money, maybe others who are not. So ideally, it's a mix. So you're not going to get like Bill Gates and all the gurus around the table, but hopefully you can get someone who's a regional guru and then maybe a few others who just give money. So it's typically a combination. But that said, I really emphasize this. Ideally, if you have a choice, try to take money from people that can help you, can open doors, that can help you grow the company, if possible, or that won't get in your way. The worst combination is people who don't know what they're doing, and they give you money and they call you every day. Did you do it? Is it ready? And they don't know your space at all, right? So you had a follow-up question?
Yeah, or they want to pull you in another direction.
Yeah.
Yeah, I like that direction. Why don't you do it?
Yeah, actually, yeah, because investments sometimes come with strings attached, right? So if you have a vision for the company and you're convinced that this is the way to go, and an investor says, okay, you want to do digital media, but how about you also offer this for oil and gas? And it's like, well, I don't want to do this, So I think being true to what your product and company wants to do is also very important.
Just last question,
Sure.
of the startups that Iliad Partners fund, is there like a particular type of agreement that you go? Because I read a lot about safe agreements. So
Standard templates?
yeah,
YC actually.
Yeah, YC now is using a lot of safe
Yeah, Y
like
Combinator.
future equity.
Yeah.
So do you use anything of that sort?
So to answer directly your question, do we have templates online? No. No. This is typically done more by 500 startups in YC, where they're sort of like cookie cutter. Our model is different. So we invest in fewer companies. So actually, we will be investing in 3 to 5 per year. And we feel like every startup is actually different. So we don't have these standard terms necessarily. But for whatever it's worth, we consider ourselves investor friendly. No, startup friendly. No, because, yeah, exactly, that would be the irony. No, because actually in the region, unfortunately, you have a lot of symptoms and cases where the terms are too harsh for startups and entrepreneurs. And myself, having been an entrepreneur myself, I've sort of seen that, and it doesn't help.
Yeah.
So.
One personal question.
Yeah, sure.
How much money the partners had to inject in this kind of, investment firm?
In our case or in general? In our case, well, I'm not going to tell you. In general, the investors put some of their own money. because it shows commitment to what you're doing.
I see.
Yeah.
I see. Okay, so it's
Go on.
yeah. Now I'm gonna ask a question related to my profession.
Okay, I'm just gonna ask a follow-up on that.
Sure.
Could you tell more about your limited partners? Where did you exactly raise the money from for Iliad Partners?
Sure.
Man, you talk so fast. Just chill.
Yeah.
Say again.
Yeah. Soon he's gonna ask me for the investor list. I can't send you this. No, so it really varies. There are vast majority of people are in this part of the world, in this region.
Okay.
So they're typically, for every VC it varies. In our case, it's high net worth individuals and family offices mainly, who really understand tech,
Yeah.
or think they understand tech, and they are interested in investing in this space. They understand the high growth potential.
Okay.
Because trying to convince someone who doesn't understand or is not passionate about tech is very difficult. But that's the profile. And then we have a few other investors from outside the region who want to buy in on the regional growth.
Okay.
But that's mainly our profile.
Okay. Well, actually, now we're preparing for the second round of investment. Like the first round wasn't much. It was like
It was your relatives, no?
$7,000. What?
Friends and family?
No. Well, friends. Yeah.
Okay.
Actually, yeah, it was friends. Well, now we're preparing for the second one. So,
Okay.
but now like I don't know if you heard of QDB here in Doha. So now they opened
Yep.
for equity fund thing. Well, anyhow, I'm doing the financial projection right now. So I'm including an expansion outside there. So this is the first question. Is it a good idea? The second question is, I also, I'm testing like some other revenue stream that I can have in the future. And actually it's tested it, like I tested it and now it's proven. But the income not clear yet, right, from this revenue stream. So should I include this second revenue stream also? And different revenue streams, you know what I mean? So because
Yeah.
I was looking into some packages, and actually some companies like, yeah, they wrote like they have like 4 revenue streams. The first revenue stream they are doing right now, but the other third, they are testing them. But they included, I mean, the other revenue stream are included in the projection,
Yeah.
and it became one of the company valuation,
Yeah.
right? So
Got it. So okay, actually, for the first, remind me the first question.
the expansion plan.
Expansion.
Also,
Okay, so this is an important point. Most investors want to see scalability. They want to see a company go from very small to very big, right? So, my generic advice would be that if you can make your company or product relevant to more markets as possible and it's feasible, I would encourage you to do so. But there's no right or wrong answer. It depends. Maybe what you're doing is specifically good for one market, and you should focus on that. But if you're looking at some point to raise significant amount of venture capital money, it will have to show that it's not just this market. It can be all of GCC, for example. So the bigger scope, the better, if possible. And the second question?
And that, no, okay, just one more question regarding the first question. So this will like make the valuation higher, right? Because, expansion
Generally, yes.
more money.
Yeah, generally, yes, but then it also makes it harder, right? So you need more investment, you have more costs.
Yeah, true.
But generally, the bigger the company or bigger the potential, the higher the potential valuation.
Okay.
But it makes it much more complex. Anyway, your second one?
Yeah.
Your second question?
Yeah. The second question was about the other revenue streams.
Right, okay. So there's no right or wrong answer there. It depends on, it depends on whether this revenue stream is relevant to what you're doing.
Exactly. It is relevant.
Okay. If it's relevant and it doesn't take you on a tangent, right? So, I mean, can you give me an example?
Well, for example, now we're doing digital media.
Okay.
Right? We are doing Wi-Fi advertising.
Okay.
So we're building this Wi-Fi advertising platform, and we succeeded with, selling ad spaces using Wi-Fi. Login pages, spaces, and stuff.
Right.
We succeeded. Like it was a really good success. And now, but there are like, for example, many other companies. They're not
Sure. Yeah.
Right. So this is another revenue stream, but it's related to what
Yeah.
we do because sometimes, for example, hotels they don't want to use their spaces with advertisement, but they are okay with
Sure.
collecting that.
That makes sense. So it sounds like, I mean, I don't know specifically, but it sounds like it's relevant. So I would say the rule of thumb, like if it's a revenue stream that is relevant to what you're doing and it doesn't take you in a different direction, then it's generally good because that means you're maximizing the revenues that you can get from your product or service. So that can be a good thing. And generally, if you can expand the scope in a way that makes sense, then it becomes about execution and how you stage it.
Yeah.
Trying to do everything at once is not easy. So you want to phase yourself. One last question, if anyone has anyone.
Can you just talk us about the timeline for example, a startup pitching to you to getting money in the bank? Because we had Astrolog guys come in.
Yeah.
They said in the industry it takes over a year for the whole process to happen.
I've seen a whole range. That's generally correct. It takes actually much longer than people realize. So, because don't forget, like raising money is not just like you have a meeting and then it happens. You need you have to understand the needs of the company. You need to build a pitch deck. You need to create all these investor marketing materials. Then you need to engage. It may take you 6 months to meet with all the VCs if they accept or are interested in. And then once you have agreement, doing the legal contracts take a while. So it could take, the fastest I've seen is 6 months.
Really?
Yeah, but then it could take up to a year and a half, a year and a half. It actually takes some time. Of course, the earlier you are, the smaller you are, and the less money you're raising, the faster it is. But I remember the Series A, for example, Glambox, we had a term sheet from the first investor, and still it took a year after that to get the others on board and do the agreements, and so it takes a while.
Same valuation because in 1 year, like a lot of things will be different.
Yeah, so this is again a matter of negotiation. We had locked in the valuation, so we were lucky in that case. But I would say, budget, a year. And if you beat that, you'll be happy, right? But it takes a while. But again, there's exceptions. You can beat it, and it can be 3 to 6 months. But I typically think it's a long process, and there's a lot, like if you're talking to like 10, 15 investors, some of them you won't know. You'll need to be introduced. There's a first email exchange. There's a meeting, a few meetings, then you deep dive. There's due diligence. There's legal contracts. All these things take a long time actually. So that's why also if you're raising money, don't go raise money for 6 months. Try to raise money that will last you at least a year and a half. So.
But then, for in that case, I mean, let's say you raise a seed round. As soon as you're done raising seed round, you're raising a Series A, so that a year later you at least have a round secured.
That's a danger that you are ending up to always be fundraising. Fundraising for a CEO can take up to 70% of his or her time, and that's a lot of time to be spending on fundraising. So that's why planning early, raising enough money that will last you at least sort of like a year and a half is key. And it's all about planning and making sure you're not, because the last thing you want is you close the round and then you start raising right after, right? So, great. Well, thank you so much. It was a pleasure. Thanks a lot. And it was a pleasure talking to you guys.